And right now it's time to welcome our first guest, Harry Dent. He's the author of the book 0 Hour. He's also the editor of the free newsletter Economy and Markets, which you can review by going to harrydent.com. But last but not least, he's a friend of the income generation. In fact, Mr. Dent was our very first guest here on the very first episode of the Income Generation. Unfortunately, that was in New York City. This time around, we get to be interviewing with Harry Dent from his home in San Juan, Puerto Rico. Harry, thanks so much for being with us today.
Yeah, nice to be back, David.
Now, we talked earlier in the show, I don't know if you heard, about newsletters that have come and gone, that have had such bad recommendations that they've just died. But you are about to have a pretty big newsletter anniversary coming up in September of this year. Actually, you're going to be hitting 30 years of your newsletter, of publishing newsletters. So tell us, what do you think attributes to that success and that longevity in the newsletter industry?
Well, I think the biggest thing, because I know not a lot of other newsletter writers, a lot of people I admire and learned from, and other authors. The biggest thing I see is, we have our own methodology, and it causes us to see things other people don't think. But sometimes you don't see something, and the difference is when we don't see when something happens we don't expect with proven indicators, then we say, well, there must be something we're missing, and we just dig and dig and dig till we found it. Like in the 2000 crash. Well, we called that, but we said, no, this is just a bubble bursting. This is not the end. Baby boomers are still going to keep spending money. Then we get to the 2002 bottom, which we called, and we said, well, we got another 5-year run coming. And I said the Dow's going to go to 30,000 plus. Well, we were right about the run, right about the timing. It was going to peak in late 2007. But I over forecast, and I just, well, why didn't the second run do as well as the the one before it, 95 to 2000? And it was the geopolitical cycle. I wasn't, the 9/11 had happened, and that changed valuations and the risk outlook in the world. So I came up with a great new geopolitical cycle over that. And so we just keep adding to our research and digging. I know a lot of other people, when something goes wrong, they say, well, if you adjusted it for gold prices or peanuts, we were really right. I don't do that. When I'm wrong, I think.
Yeah, that's data mining. You just have to kind of man up, as I know you do, and say, hey, I was wrong on this one call. It is what it is. But you haven't been right all the time. No one has, but you've been right more than you've been wrong. So, I know you're a Harvard-educated economist. But newsletters come from people from all walks of life. Do you think being an economist gives you a certain advantage over some others, perhaps, when writing a newsletter?
Well, my advantage is that I'm not an economist. I was a Harvard MBA. I studied business and marketing and management and strategy and accounting and finance. And I worked in, consumer-based companies, entrepreneurial companies, Fortune 100, Bain & Company as a consultant. I started in economics, and after 3 courses, I said, this is useless. Nobody understands economists. They disagree looking at the same facts, unlike the economists, scientists I study. And economists basically say nobody can predict the future past the next election. I'm like, well, why should I study economics? I want to be able to tell people what's going to happen 5, 10, 15, 20, 30 years, the rest of your lifetime and your kids' lifetime. And we've been able to do that by looking at things that are projectable. And the truth is, David, much more, the long term is much easier to predict than the short term. And the economy is far more predictable. I can tell your kids and grandkids when the next crisis like this, a kind of a bubble and depression crisis is going to be today. That's how predictable long term is. What's hard to predict is what Donald Trump's going to tweet or do tomorrow or next week, what the market's going to do next week. That's hard to predict.
Yeah, that's it makes a lot of sense. So it sounds like, in large part, you're attributing a good part of your success to being brutally honest with yourself, right? The old Jack Welch, be brutally honest with yourself no matter what. If you get it right or you get it wrong, doesn't matter. And also being more diverse in your background, more well-rounded, looking at it from all sides. I think that makes sense. Harry, we need to take a commercial break. And I know you're going to stick around for a minute. Thank you. And you stay with us also. We'll be right back here with much more from Harry Dent on the Income Generation. I'm David Scranton, and we'll be right back. Right now, let's welcome back our guest, Harry Dent. He's the author of the book 0 Hour. He's also the editor of the free newsletter Economy and Markets, which you can review by going to harrydent.com. Harry, thanks for sticking around.
Good.
Now, I know you and I think the same about one important thing, and that is we're at risk right now of having bubbles in many different places in our economy over the next few years with the effects of quantitative easing, what I call economic steroids that have artificially pumped up. We've had this great asset recovery, maybe even more so than economic recovery, and eventually all that can turn the other way. Tell us your thoughts about that.
Yeah, the boom up until 2007 was baby boomers growing up, something we absolutely predicted 20 years before that. Technology, internet, personal computing moving mainstream on a predictable S curve, another thing we predicted. But then we went into a downturn that started to look like the Great Depression, or what we call the winter season of debt deleveraging. And of course, we had big debt bubbles into 2007 and 8. But what had been quantitative easing, and all of a sudden the stock market's gone straight up in the slowest recovery in all of history. The stock market's gone, I mean, the real GDP's grown no more from 2007 to 2018 than it did from 1929 to 40 during the Great Depression, yet stocks are at massive new highs. Stocks have gone up because earnings per share have gone up 120% faster than earnings.
All the corporate
because
buybacks.
Of quantitative easing and stock buybacks. Almost all the buying in stocks, net buying, has come from corporations buying their own stocks, and then you have governments and central banks buying their own debt and pushing down rates for everybody to zero adjusted inflation and allowing them to float massive debt and to fund that debt at very low interest rate. It's an entirely artificial economy. And this comes into the 2007 top was predictable. 2001 was when our geopolitical cycle reversed down and valuations went down. But this, we're hitting our most powerful long-term cycle, the technology cycle, which on a double cycle peaks every 90 years. And the anniversary of the 1929 top is coming about the same time as my 30th year anniversary for my newsletter in September 2019. So I'm saying this bubble is finally going to peak most likely late this year, early next year. Could even extend one more year because you know who wants to get reelected. Right. And probably will be sending checks in the mail on top of tax cuts.
And it's kind of hard betting against the Federal Reserve also, correct?
Yeah. But again, since it's artificial, you can only blow up a bubble so far. Bubbles are, and I hate to say this literally, I used to show a chart even 10 years ago comparing the Roaring 20s bubble with the Masters and Johnson orgasm study, male orgasm study, scientific study. And it fits perfectly in every bubble in the world today, whether real estate, commodities, stocks around the world, fits that model. And that model goes up and it gets more exponential. And then when it bursts hard. There is no soft landing.
So Harry, this brings me, in the minute we have left in the segment, this brings me to something you told us last time you were on the show. You said that, every time it gets a little higher and then it gets a little lower. It gets a little higher, it gets a little lower. Based upon what you said, you kind of hinted toward the fact that the next low is likely to be maybe 50 to 70% down from where we are today.
More than that way? Yeah. That megaphone pattern, higher highs and lower lows, the next low would be at least 5,500 on the Dow. And I think the Dow in this final bubble, I think we're in the final phase, and I think it's going to go to something like 33,000 by later this year. I mean, because bubbles are progressive. So this last wave up, which I think started in December, that could take it to 33,000, then it could go to 5,500 or even 3,800. There's another thing we mark, the bubble origin. Bubbles tend to burst back to where they started. If you go back to the late 94 origin of this stock bubble, you'd have to go to 3,800. So 3,800.
And Harry, we need to take a commercial break for just a minute. Sorry to interrupt. We'll finish that thought when we come back. Stay with us. We'll be back with more here on The Income Generation. I'm David Scranton. We're with Harry Dent. We'll be right back. Now we're going to bring it back in our guest, Harry Dent, for one last segment. Harry is the author of the book 0 Hour and the editor of the free newsletter, Economy and Markets, which you can review by going to harrydent.com. Harry, thanks for sticking us around. Sorry to have cut you off, but you're talking about Dow as low as 3,800?
Yes, and probably by 2022. We have three big long-term cycles that all come together between 2020 and 2022. The economy tends to bottom maybe a year after that. So 2020 to 23 is the danger zone. And late this year is when this major bubble, the biggest bubble of all time, the most global, the most steep, is likely to peak. And at the latest, 1 year after that, if Trump can keep the economy going by sending free money in the mail.
Okay. So you're basically saying maybe we have 10, maybe 20% on the upside over the next
I think
six
more
to
than
18
that.
months?
I'm looking at a 10,000 NASDAQ and 33,000 Dow. So it's even more than that for the NASDAQ. And it's way more than that if you go from the December low where we started to tell people. We call it the dark window. It's the last rally just before the big crash. The best of the rally, then the worst of the crash, right next to each other.
That's a huge blow off, but then the drop to be as severe. So it's interesting. I've always said we have to go below 1,500 on the S&P, and very well can break through the 666 from the S&P we saw March 9, 2009.
That would be the minimum, 666.
You're calling even a bigger bear market. So in the last minute we have left, tell our income generation members, those over the age of 50, layman's advice, what does this mean to them in terms of how they should invest their hard-earned retirement dollars?
Well, one thing, later this year is the danger zone, especially if we get near that NASDAQ 10,000. You can either start, selling stocks, or you can hedge. If people don't realize, in a bubble like this, when there's so much upside and very little correction, options to hedge. You can go to your financial advisor and hedge your stock portfolio and not have to sell them and pay taxes and worry about missing the bubble. And only can cost like as low as 3% to insure. But the major point is, in a bubble burst like this, everything goes down. There's nowhere to hide. High quality bonds, 10 and 30-year treasury bonds, and the U.S. dollar bonds will do the best. And that's what happened in 2008 and 9. Everything went down. The dollar went up, and high quality bonds went up, and gold and silver went down as well. So gold and silver is not going to save you.
No, I agree. Gold and silver doesn't produce any income. At least high-quality bonds do. Stay away from junk bonds at that point. Stay out of the market.
Junk bonds trade like stocks in a downturn.
Of course
like
they
this.
do.
Junk bonds are the worst place to be. The money goes to highest quality bond and highest quality currencies. That's exactly what happened in the 30s, and that's exactly what we see happening here.
Harry, some good words of wisdom. I love it. Thanks so much for being back on the show. We really appreciate it. And you stay with us. We'll be back here with more on the income generation. I'm David Scranton, and we'll be right back.